The Guaranteed Income Benefit Calculator is a convenient way to test if converting an asset into a SPIA, or single premium immediate annuity, or if taking advantage of lifetime income benefit features on an indexed or a variable annuity adds value to the financial plan. You'll have the option to test both scenarios with any of the existing liquid or pension assets that you have in the plan. The first thing you'll want to do is select the accounts up for testing and indicate whether you want to use all of the account value or input a partial dollar amount. Next to the account selection dropdown, you should notice a Taxes Out radio button. This is set to no by default and illustrates the guaranteed income benefit if the client were to pay all taxes due on the asset up front. In most cases, this is going to be left on no. The next radio button to address reads, "Is this a SPIA?" Since most guaranteed income scenarios are done through guaranteed income benefit riders on indexed or variable annuities, this is by default checked to no as well. After that is taken care of, we'll need to fill out all the rest of the details in the input boxes below account selection. The first boxes are start year and end year. These are defaulted from 1 to 40 and represent lifetime income. But should you recommend a 10-year or a 20-year SPIA payout, for example, you can adjust these input boxes to match. If you're planning to purchase an annuity or the client already owns an annuity, you may want to fill in the GIB return field and corresponding radio button as to whether the GIB return is simple or compound. Because you will later input the actual income payout, this input is only for illustrative purposes in the report. It will not affect the growth of the actual asset or account value. If there is a bonus on an annuity recommended for this guaranteed income benefit, input that next. If you have selected a pension account, the exclusion ratio will be inactive as the tax rate will simply be at the normal income tax rate for all distributions. If the annuity is non-qualified, an exclusion ratio will be needed to determine the taxable portion of the cash flow, so enter that next. After that, input the year in which the income stream will begin in Guaranteed Income Benefit Start Year and the exact dollar amount of that income stream in the year it is scheduled to start. Now that everything is filled out, you can test the value of a guaranteed income benefit and apply it to the plan if desired. In the report, you'll see all of these details illustrated along with the hypothetical account value and annual return column so that you can show the client what this would have looked like if not made into a guaranteed income benefit. The returns in this hypothetical field will be subject to the static return of the asset or of the market dynamics return periods selected on the asset. It can be used as a sales tool in illustrating the value of performing this recommendation later when you are meeting with the client.